What we now like to work on is a little bit about special purpose framework, and in particular, when you see a cash basis financial and you need to convert it to full accrual. We're going to start with the cash basis numbers, and then we're going to look at changes in receivables, payables, and things of the sort, and then figure out how does that impact the cash balance to ultimately equal the accrual balance. We've got a lot of items we'd like to show you and work out with you. Let's take a look. What we're going to have here is we have an organization. We have the S corporation, and what we have is we are going to show a cash method. Cash in, 550,000, cash out, 370,000. So therefore, cash basis net income was $180,000. The company's accountant kept track of beginning and ending balances to accounts receivable. You'll notice that in this particular case, accounts receivable went up. Remember, year 3, the current year, is there. Year 2 is on the right-hand side. Again, the examiners can twist those around. Be aware of that. So in this particular case, there's been a change in accounts receivable. That's probably sales that haven't been collected yet. So that's going to be added to the cash receipts to increase revenue under the accrual method. We have prepaid insurance. You'll notice that that went up. That was items that went out the door, which cash method would call an expense, but we would say is not an expense. It's going to be a prepayment towards next year. Inventory went up as well. So some of the payments we made were for items we haven't sold yet because it went from 20 to 30. So some of the purchases were for ending inventory rather than cost of goods sold. Accounts payable went up, which means that we need to increase certain expenses like purchasing of inventory, because that particular item was bought, but we haven't paid for it yet. Cash waits until we pay for it to show an expense. We would, of course, indicate that that was part of the inventory / falling into the cost of goods sold because it had been bought. And then salaries payable went up. So we owed the money, we just haven't paid it. That's an increase to the expense because it's been incurred, it just wasn't paid yet. So we have that as our starting point. And then, of course, the next thing we want to consider is we say cash basis does not equal GAAP. The accrual basis is GAAP, and that's the one that we're going to want to use. So the very next thing we're going to look at is we have to make some adjustments. We're starting with cash received, but what about some invoices that were sent out because we delivered the goods, but they haven't paid us yet? That ultimately means that we are going to have to report that as additional revenue. So in this particular case, we're going to adjust revenue, but changing the invoice in this particular case is going to be part of that process. So you'll notice right here in this particular case, what we're going to say is that we have the widgets that were purchased, and we're going to have to factor that into the process. Then the next item is we have to calculate the accrual basis revenue for the year. So we're going to start there and we're going to figure that out, and we will do that in just a moment. And we also have to look at expenses that have been incurred. And when it comes to those expenses, we're going to have to adjust them. An example, total cash paid, $370,000. But we had the inventory. We had widgets, and we had other expenses of $270,000. We're going to have to factor that in. And of course, we have to make adjustments to the cash payments for inventory, which were recorded as $100,000, but we had some other items. We bought items that received before the year end and we owed the money. We didn't pay it until later. So that also has to be factored in. So those are some of the items that have to be adjusted as we go forward. So we're going to adjust cash payments for other expenses. We started with the amount being, in this case, let's say it was originally $370,000, but we had other items such as cash paid for insurance of $15,000, cash paid for salaries of $255,000. So we've got lots of different items that need to be adjusted. So we're going to start off with some discussions here. Strict cash basis reporting, cash and equity only are on the balance sheet. The income statement would treat all cash inflows as revenue and all outflows as expenses. The accrual basis recognizes revenue when realized or realizable and earned, and expenses when incurred, owed, and benefit has been received. Therefore, revenue and expenses may be recorded in different periods, different time periods, than when they would be for cash purposes. This results in balance sheet accounts for current assets, current liabilities like accounts receivable, accounts payable, inventory, prepaids, unearned revenue, as well as long-term assets and liabilities such as investments, PP&E, and notes and bonds payable. To prepare an accrual-based income statement from a cash basis statement, the following adjustments must occur. You have to convert the cash basis revenue to the accrual basis. Then you have to convert cash paid for purchases to the accrual basis for cost of goods sold. And then you must also convert cash paid for operating expenses to the accrual basis for operating expenses. So, in this case, in year 3, the company had $550,000 in cash receipts, $370,000 in cash payments, or, and I should say of which, $100,000 related to inventory purchases. Using the balance sheets known by the accountant, accrual net income can be generated. So first, let's adjust the revenue. The company must account for revenue earned during the year but not collected in cash. And of course, cash collected during the year that didn't relate to last year. The invoice in image 3 is sales revenue that should be recorded in year 3 under the accrual method, but wouldn't be reflected in the cash receipts of $550,000. To capture this type of activity, we add the ending AR because it reflects revenue earned this year that would not have been collected until next year. And we subtract the beginning. You'll notice you can do the differential between the two, or you can do the gross approach, which is what we're suggesting here. To adjust expenses, the company must account for expenses incurred but not paid in cash, and cash payments that don't relate to the expenses this year. So we have another image that shows you the split of expenses. Inventory, $100,000 paid, but the invoice in this one image that we're showing you of inventory purchased during the year that wasn't paid for in cash. The company must account for this type of activity to generate an accrual-based number. So the balance in accounts payable are used to take cash paid for inventory and generate inventory purchases on account. Then the inventory account balance helped generate the cost of goods sold for the inventory purchase balances. Other expenses also. We had $270,000 paid for all other expenses, $15,000 for a new insurance policy, and $255,000 for salaries. Again, the company must account for expenses incurred but not paid in cash during the year, and then cash payments that don't relate to this year because they were actually last year's. So an adjustment to the $270 based on the balances in prepaid insurance and salaries payable will convert it to the accrual basis. We can explain reasons for adjustment basis to the T accounts that we're going to see. And finally, the accrual basis calculation presented in this particular item would show you our spreadsheet. So if we take a look at this one, we'll start with the first T account. We had cash receipts, $550,000. We add in the ending receivables, that's sales made this year but haven't been collected. We subtract out the beginning accounts receivable. That was collected this year, but it related back to last year. And we actually now have $593,000. So that helps us with understanding how the balance worked. We then take a look at our next item, calculating cost of goods sold. We have cash payments for inventory of $100,000. The ending accounts payable were inventory bought, but we won't pay for until next year. We then subtract accounts payable at the beginning of the year. Those were paid this year, but they really related to inventory bought a year ago. We take the ending inventory and we subtract it out because that's items that haven't been sold yet. The beginning inventory is added in because those items are presumed to have been sold. And we now have cost of goods sold of $110,000. We then look at calculating other expenses. We start with cash payments of $270,000. We add in the ending salaries payable. Those are salaries incurred this year. We just haven't paid them yet. The beginning salaries payable is subtracted out. That was incurred last year, but paid out of cash this year. We then take the inventory prepaid insurance, and then we adjust it for the beginning. So we have accrued basis operating expenses, and in this case, it's $271,750. So once we're done with that, we can do our accrual basis net income. As we've indicated, we have $593,000 of accrual income minus the cost of goods sold under the accrual method, which is $110,000, minus the accrual expenses, which is $271,750, and that aggregates up to the accrual income here, which is going to be $211,250.